All right. Thank you, Ryan, for joining us. And thank you, Chris, Samuel. I know more people are going to be joining this call, but I figured it's better we get started for the sake of time because we did plan this to be um, an hour meeting. So I'm happy that we have a few of us joining early. Today, we're walking through how we are going to structure an 8-unit apartment development in Edmonton using a 500K capital raise with a strategy to refinance through CMHC and return investor capital while maintaining ownership of that uh, building, right? Now, I just want to do a quick introduction. My name is Kelechi Amadi. I'm the broker of record, Real City Realty, and I've been in the industry, real estate industry now for just about over 15 years, 16 years, I would say. Um, I'm focusing more on buyers, sellers, investors, generally helping people in the real estate field. Now, not only that, I also help real estate agents achieve their dreams of running their own businesses. And this is what I've been doing for the past 10 years in that area. And it's been great. I'm joined today by Ryan. Ryan is the owner of RHE Consulting, right?
Yes.
And he will be the person in charge of, the execution of this project. I would like Ryan to introduce himself, give us a kind of a backstory. Ryan?
For sure. Yes. Yes. Thank you. Yeah. So been in Edmonton for since 2012 from Philippines. Started my first business when I was 17 years old. I know I look young, but started a painting company. Yeah, 13 years ago. And so now I have about $10 million worth of multifamily real estate that I built from the ground up myself using this strategy that we're going to show you. And I built that in less than 2 years. And currently, right now, I have $17 million worth of ongoing projects right now with clients with this exact strategy that we're going to show you guys.
That's perfect. Thank you, Ryan, for taking your time to join us today.
Absolutely.
Appreciate it. Appreciate it. This will be like about a 45 minutes presentation. At the end, we're going to have a 15 minutes Q&A. And basically what we're going to do is quickly run through what CMHC means and what the basic structure, the loan program, um, what it entails. All right. Most people here know about CMHC because I believe most of us understand what CMHC is, Canada Mortgage and Housing Corporation. They are basically the national the national housing agency owned by the federal government. Okay, and they were created basically to help Canadians access housing by providing mortgage insurance to lenders, funding and supporting rental housing development, and offering programs like the apartment construction loan program that we're talking about today. And in simple terms, CMHC reduces the risk for banks, which allows the banks to lend more money and lower interest rates, especially for real estate projects. Now, this program is called the CMHC Apartment Loan Program that we're going to be talking. It's actually the core of why I think this is a good idea for investors. But I would like to quickly explain it because the program is a government-backed financing program that helps developers build rental housing, okay, with low interest rate and up to 95% of the project cost is covered. Um, it offers interest-only programs, payments during the construction. We don't have to always use them during the construction. You can always focus on the refi. And they have long amortization of up to even 50 years, making it easier for projects to be done and, increasing cash flow for investors. Investors can build, refinance, and do that at a higher value, recover most of all their initial investment, the capital, and still keep ownership of the cash flowing rental property. So that's what CMHC does in this project, and it's the vital part of this project because without that, it would just be like every other type of investment where you buy a property, build it, and rent it out, and keep owning it, but you have the investment in it, right? But in this case, you can use this program to take out your initial investment while still owning the property. That is a very good advantage for this property, this project. Now, we have chosen Edmonton, thanks to Ryan, who's in that area. I will share my screen to give you more of an idea of what we're talking about here. So basically, we chose Edmonton for different reasons. All right. And I want to talk about that because Ontario is also, capable of doing this. But why Edmonton? Why Edmonton? First of all, we have four pillars that I'm going to be focusing on in this presentation because Edmonton has really grown in different aspects that makes it important, or makes it more or less a good spot for what CMHC is doing with projects like this. We have the first pillar, which is the population growth in Edmonton. In the past years, we've had over 3.38 growth year over year in their population growth. It's one of the fastest growing major cities. They have a strong inter-provincial migration from Ontario. Most people are now thinking of moving to Alberta. That's a trend. And high levels of immigration settlement. People from outside Canada are really considering Alberta as their go-to location to settle. We also have more young families and workforce renters, And why does CMHC care about these things? Population growth guarantees long-term housing demand. The fact that we have the population growth also reduces vacancy risk, improving project stability. And what's your takeaway as an investor? Well, you're not second guessing demand. It's already coming. The demand is there, and that matters to you as an investor. Another important aspect is the employment trend. Income stability. Now, Edmonton has a diversified economy. It's diversifying economy. And in just 2026, this year, January, they added over 20,000 jobs. And in Edmonton alone, that's in Alberta, but in Edmonton alone over 5,000 jobs were added in January 2026. We have industries like oil and gas that are still strong over there, a growing government and public sector employment, expanding tech and logistics sector, top industries, healthcare, construction, manufacturing. Why does CMHC care about this? CMHC cares because there's a stable employment, which means that tenants can consistently pay their rent and will have lower default risk on the building's income once we have a project built out. And as an investor, what's your takeaway? Well, you have reliable tenant base, predictable cash flow, and easier financing approval. That's very important as an investor when you think about employment trends. Now, sustainable housing growth, policy alignment, sustainable housing growth. Over 10 years now, there's been a growth of 19% over 10 years. Single family homes cost average of around $450K. Now, this allows for multi-unit development on more lots. When you have single family homes costing less, which means you can buy a single family home, which is a detached home, for a lower amount compared to Ontario, do a breakdown and build up for this project or something like this project. This encourages infill and density. It supports energy efficient construction. And why does CMHC care about things like this? Well, CMHC prioritizes affordability, energy efficiency, accessibility. These are important to CMHC, and that's why CMHC cares about this sustainable housing growth in Edmonton. Edmonton makes it easier to hit all three higher MLL select scoring. All right. These are the things that CMHC looks for when investing or refinancing projects like this. So for you as an investor, what's your takeaway? Well, you unlock better financing terms, which are longer amortization, higher leverage, right? Then finally, the fourth pillar, which I think is very important in this project, is the rental attractiveness. The rental attractiveness, cash flow strength. Edmonton is one of the best cash flow rental markets in Canada. We have average rent now about 15 or 1600 for a two-bed, two-bath. Brand new units could go between 1900 upwards of 2100. These lower costs attract inter-provincial relocations to rent first. So you see why people see that as a very good place to move to from Ontario or from somewhere like even in Vancouver, This lower purchase plus build cost helps for us to have a better rental market. The strong and rising rent in other areas makes it an attractive place. And then relatively low vacancy, right? And I believe, and correct me if I'm wrong, there is no rent control, right? Right? No rent control in Edmonton.
Yes, that's correct.
Yes.
There's no rent control. Once a year is where you could increase the rents, but there's no cap.
Nice. Which is very important. And why does CMHC care about this? Well, you have a strong NOI, which means safer loans. Um, you have you meet all the requirements that CMHC has set for a project like this, which means higher loan approvals, right? And what's your takeaway as an investor? Well, your project can cash flow from day one. It can appraise higher, okay, and refinance more aggressively. So that is a very, very important aspect of why I think Edmonton is actually one of the best places to carry out a project like this. All right. Now, the big picture here, how this wins for the CMHC loan factor, as I said, the population growth, it ensures demand, employment trends, ensures rents get paid, sustainable housing unlocks better CMHC terms, rental market attractiveness, maximizes valuation, and refinance. So Edmonton checks all CMHC's boxes: strong population, the stable employment, the pro-housing policies, and one of the best cash flow rental markets in Canada. That combination allows us to build effectively, lease quickly, and refinance at a high valuation while maintaining long-term stability. So this is why we have chosen Edmonton as our go-to for a project like this. All right. So this is why this works. And I think what matters here is having that, possibility of you getting back most of your initial investment. Because once you invest your money, most times in real estate, you only depend on the future of maybe 5 years refinance to get some money back or all money back. But in this case, within 12 to 24 months, you could actually get your money back in full and still own a very cash positive property. So that's why I think this is a very good idea for those who are interested in still looking at real estate investment. Why small apartments? I think for the fact that, financially speaking, it's a little bit easier to get funds or funding for smaller apartments. The rule of thumb here is it has to be above $1 million, and if we can get at least 8 apartments for the amount of money we can spend, which is what we're going to explain better after Ryan breaks down the projects, how it works. We're going to break down how the money is used and how it's done and all that stuff. But it's easier to get funds for this, and it's a little bit quicker, when you're building a small apartment. All right. And basically, before I talk about, the financials and the, strategy and all that, I would like Ryan to please just do a quick breakdown of how these projects work. All right. So, Ryan, I'll give you a few minutes here to take it. Um, Go ahead.
Yes, absolutely. Let's see. Yeah, so thank you so far. So what I'll do, I'll share my screen. Hopefully you guys are
Let me
on a
stop sharing mine.
oh,
So, all
yeah.
right, go ahead.
Oh, I need permission. So I
Okay,
need yeah.
go ahead.
Okay. So hopefully you guys are on a computer. If you're on your phone, it might be hard to see. But hopefully you guys can see my screen here. Can you guys see my screen here?
I can see it.
Yep.
Yeah.
Okay. So this is just why you should develop. Um, this is just a case study. Before I was developing, I was buying existing units. Okay, so I bought this 9 units at 820. I sold it for 860 within 6 months. So I made some money, but there was a lot of headaches, constant repairs. This was a 1950 building, so there was not enough cash flow to support a property manager. So I was actually out there hustling and you know just making sure that I could actually manage the building. But then when I built my own, you can see I created like 400,000 worth of profit here. Peace of mind, everything brand new. I could pay a property manager, no problem. And I'll show you how I was able to do this and how it works. Okay. So this is my first ever development infill. Okay. So I bought the lot for 390. So when you buy the lot, you don't need all cash. You can if you want. That's what I'm doing now. But I bought it for just 35% down payment. Okay. So 35% of 390, 136. That makes sense so far. Pretty sure. Now on top of that, we do need to spend another, right now it's around 200,000, but in this project I spent 180. Why? Because we need to do all this work, blueprints. We need to disconnect all gas, water, electricity. We need to spend for a plot plan. We need to spend for energy report. We need to spend for structural engineering, civil engineering, demo, abatement, fence rental, permit. So here's a breakdown. Long story short, you need to spend money before we can get construction financing. Okay. So hopefully this makes sense so far. So total all-in cost is 1.9. Okay. Now it was appraised at 2.5. So meaning I created, 600,000 worth of equity in one project. Now this is where the secret happens with developing is infinite compounding. Okay, this is the developer secret number one. So I'm sure you guys heard this before. Albert Einstein says compounding is the eighth wonder of the world. I'll show you why. Because the total cash I invested, right? 35% for the land, 180 for the soft cost. I spent around, less than 350,000. Okay. Um, but my total cash return, you could see, I got 95% loan to value up to 2.5 mil. Okay, so now things are a little bit different. You can't get up to the entire 2.5. You probably around 2.2, 2.3. Just keep that in mind. But for this case, let's just do an example of the math for 2.5. So that's 2.4 mil we get back. So when Kelechi was talking about getting the money back, this is where we get the money back at the end once the build is done. Okay. So now remember, my total cost was 1.9, right? And then we got 95% off 2.4. So you can see we got 446 out at the end. Okay. And so 446 plus, remember, I put in 317 inside this 1.9, right? Because land and 180. So we got back 763 tax free at the end. Now, again, remember, now this is very aggressive. Nowadays, we can't go up to that total total appraisal. Um, now it's a little bit, I'd say 200, 300K less of the appraisal is what they'll give out, but the numbers still work for really good. So that's basically how it worked. Yeah, turned 317 into 500 tax free, built 500K equity. This is what Kelechi was talking about. You kept the building too, cash flowing. This one, I'm actually cash flowing more because the numbers worked out better. So cash flowing around 2,000 a month and did it again. Um, so yeah, that's kind of how it works.
All right. So basically, Ryan, I'll just quickly ask a few questions here. So currently now, what is the average price of a detached property with land that we can use for a project like this?
Yes, so I've got a bunch of off-market opportunities that we can jump on. The trend between 350 to half a mil around there.
All right. And I guess one can use anywhere from 20 to 35% down.
Yes, yes.
And then you said soft cost of 180. Does that basically do you always use the CMHC construction loan, or do you use the private construction loan when you do your
Yeah,
construction?
I've done both. You know what? They both have their pros and cons. CMHC cheaper, um,
But harder to get that
longer
way.
timeline. Not harder to get.
Mm,
It's actually easier to get,
okay.
believe it or not. But it's a longer timeline, so it takes 4 or 5 months for the first draw.
Okay.
Conventional financing, like I mean, quicker, easy as in quick, but harder because you need to put up more cash. So instead of buying, instead of putting up 180 for the soft cost, they might want to see 350. So we might have to go to lockup stage instead of
Mm,
180, right? So
okay. Okay. So do you mostly then rely on CMHC for the construction as well?
yeah, I've got a mix of both for, again, it's super, it really depends on the group, what your
Hmm.
group is looking for. If you're looking for the fastest turnaround, um, but you have more cash, then just do, conventional construction.
Hmm.
But if you want better terms, and by terms I mean the cost of the construction loan, but you don't mind waiting another 5 months for the financing, then CMHC is good.
Okay, perfect. And how long would it take for the project from start to finish? Like average amount of months for it to be
Yes.
completed?
So me and my team, we can build in 7 to 10 months
Okay.
after permits. So
After payment.
permits take, say, 5 months. So
Okay.
5 plus 10 is around 15 months. Right?
Oh, I see. So can one do the permits while waiting for CMHC loan, maybe? Is that something that one
Yes.
can do?
Yes.
Okay. So
So
that way,
there
when the
is
permits come
could save
in, you
time.
have the loan as well. Oh, okay, perfect. So
Mhm.
in total, the time frame is average around what time to what time?
Yeah. Yeah. So again, if I build in 10 months, permits take 5. So you just add both.
So that about 15 months. So we're looking at maybe an average 15 to 18 months max.
Yeah.
And the refinance happens right away?
Yeah. It's automatic.
All right. And how's the evaluation done by CMHC? So basically, when you're done, do we tell them what it's valued, or do they just send their own people over to evaluate
Yeah.
it?
So part of that 180 from the beginning, that includes spending appraisal. So even before we start, we already know what the value is. Even
I see.
before we put a single piece of nail, we know what the value is because they do what's called a as if complete appraisal. So they
Ah,
do market analysis and they do backwards math based on what the rent will be 12 years, 12 months from now.
okay.
And so that value is what the banks will loan against from the beginning.
Oh, perfect. Perfect.
Yes.
Okay. Sounds good. Sounds good. So I guess this clarifies some questions that I think people would ask, but I guess at the end we're gonna have some question and answer. For the
Yes.
next 5, 10 minutes, I'll just quickly talk about the financials. And for the part of the JV, I can't go into full detail because it's gonna be very complicated. However, what I would do is when we have anyone interested in getting into the project, we'll have a one-on-one call where I break it down in detail, okay? Because those financials tend to be, a little bit muddy, So in this call, I don't want to waste 30 minutes explaining something that I could still have a proper call with you and break it down once you're ready to, invest if you're interested in investing. So, but I would like to break down the financial part of it, which is the raise is 50, I mean, is 500,000, And the minimal, let me share my screen here. So basically, yeah. So the minimal investment is 50,000, and the reason why we made it that way is because we want to have a maximum of 10 people in a group if need be. We don't necessarily need you to bring only 50. If you can bring 100,000, that works. If you can bring the whole thing, that works. And that would determine how we structure the JV or the corporation that would go ahead to do this project. Now, once we have the number of people involved, we're going to be creating a JV, a joint venture, and that joint venture will have an account opened. I will be dealing with the management of the capital raise side, and Ryan will be dealing with the project itself, right? So in essence, we're going to do all the organization effectively and explain it to you before you even invest, understanding how you're safe, you're protected, and how your money is going to be basically used. Now, for the money, the strategy, basically, it is very straightforward. The step one is obviously raising the money, and we're thinking of this first one to be done within the next 2 to 3 months. That's the goal for the first set within the next 2 to 3 months. And then what would that money be used for? As Ryan has broken down the project, the money will be used to leverage for the land purchase, the permits, the initial equity, all the small soft cost. The total project, as Ryan has explained, would cost anywhere between, I would say, 1.5 to 1.9, maybe, around there. Ryan, correct me if I'm wrong, but that's the range, I believe, right?
Yeah, yeah, exactly.
Okay, perfect. And then after build, we're hoping to get between 2.2 to 2.5 million evaluation. Now, as you have heard, when the refinance is done, we intend that everyone gets their initial investment back fully, but I always tell people prepare for 80 to 100% return, but we hope that you get everything back. Okay. Once everything is gotten back through the refinance, we now keep the property and rent it out as a new cash flow property investment for the owners, right? Now, the group can always decide to do whatever after. It's just going to be a situation of voting and deciding as a group. So basically, as the ownership goes, one can decide to sell or do whatever they want to do, but that's something we can talk about when we create the joint venture agreement. All right. And that's the most important point because investors can, after the refinance, receive most of all their initial capital back while still owning the property. That's the very, very most why I'm interested in this is because of that main part. And now, of course, there are going to be risks, okay? Things like construction cost, timelines, final valuation, but we are mitigating these through our conservative assumptions, right? We're mitigating this through working with someone like Ryan, who has done a few of these projects and understands the ins and outs. So that's how we're trying to mitigate some of the potential risks that we might come in. And also, the fact that we have CMHC backed exit strategy helps us to mitigate some of the risk, all right? And preparing for any contingencies, we're preparing for that if any, all right? Now, I'll answer a few common questions first and then open it up for questioning if anyone has that. We have already talked about timeline, how long it will take. Well, 15 to maybe 18 months. Where basically we've talked about how the CMHC refinancing works. Once the building is done, we already have a, I guess, valuation even before it's built, and they use that to now come in and evaluate if it meets their requirement, and the financing goes through quite quickly once everything is done. And the minimum investment is 50,000 just to control the number of people in a group, right? And this is basically, those are the important points I would say most people would have. But I would like to open it up now for questioning. I'll stop sharing my screen here. And then if we have any questions, I guess this is the time for us to ask. And I've recorded this meeting. I know that a lot of people who signed up didn't come in, but that's fine. I think with what I would do is send out to all the attendees the recording, and then they can also reach out to me. But if you have any questions, please feel free to let me know, and then we can answer your questions as well. Do we have any questions? Okay, I see a question here. You cannot start construction before approvals. Please clarify. I will give that to Ryan. Ryan, what do you think? He's asking, you cannot start construction before approvals.
Absolutely. You cannot do any construction without any approval. So when you say approvals, I'm assuming you're talking about permits. So
Yeah.
of course you need, so there's two permits, well, three. So first is the demo permit. If there's a house, you gotta get a demo permit. But once you have the demo permit, right, um, we're waiting on the DP, development permit.
Hmm.
Once you have so that's the longest one. That takes 4 or 5 months usually. Sometimes we get lucky, it gets 3 months. Um, and then, but once we get that, we're flying, and we could then the last one is the building permit. So the building permit, that's when we issue our insurance, we get our warranty, etc., and that takes 3 to 4 weeks. So to answer your question, yeah, no, we can't start any construction before we do the approvals, and that's where Kelechi was talking about the initial 180,000. That's going to be used towards getting the permits.
All right. Thank you, Ryan. Okay, we do have another question from Chuka. Are international investors welcome? I would answer that and say yes. International investors are very much welcome. The good thing about this is that it's considered a commercial project, and due to the restrictions, most investors, international investors, do not tend to, they're not allowed actually to invest in residential right now. But for the commercial side, um, this is allowed. And Ryan, if you want to add something to that, please do.
Yes, I have a group that I'm working with. I have clients. There's seven of them, and six of them are from Africa. And so they put money together from Africa, and the main owners in the corp are Canadian, and so they just gotta be majority shareholders.
All right, perfect. Yeah, the residential ban will be lifted in 2027, but for now, yeah, international investors invest in commercial projects like this. So yes, thanks a lot for that question, Chuka. Yeah. Do we have any other questions?
My hand is raised. Okay.
Oh, yes, sir. Chris, please.
Yes. Yeah. Thank you for the opportunity. I just listened carefully. Um, from what I gathered, correct me if I'm wrong. Um, you said one of the eight units cost about 1.9, and the minimum down payment will be $50,000. And so how many, so if some, say for example, one person pulls down the $50,000, another person pulls down the $200,000. So how do you apportion the ownership upon completion? That's
Good.
one.
Mhm.
And another question would be, is this project in the city center in Edmonton, or is it in the suburb? Because that's something you also want to look at, because the chances of it being able to rent, quickly if it's in the suburb will be, reduced as against if it's in the city center or close by the city center. Those are my two questions.
Okay, good. I'll answer the first part and then I'll let Ryan answer location questions. Okay. Now, when we talk about the JV, the joint venture, as per the number of people and the amount they invest, we're going to allocate ownership based on that percentage. Okay. So I'll be breaking that in detail once the investment starts. But for explanation basis for this video or for this meeting, if you bring 10% of the total amount allocation, and I say this, I clarify, very important, because there are going to be two parts when we do the JV, which will have a operational partner and shareholders. But for the ownership, it's going to be that percentage, all right, of your investment in essence, right? So if we have 500,000 and you bring 50,000, the ownership is 10%, basically, right? So
Okay.
I'll explain better though, because there are other things in detail that I have to talk to each investor about when the time comes to actually sign the paperwork and understand how this structure works. But that is more for the simplified answer for that question, because the goal is to raise an amount of 500,000, which we need as the foundation for the project. And then the ownership will be based on that. If you bring the whole thing, you own the whole thing. And it's quite basically going to be based on that amount. All right. Then Ryan, could you please answer us for location?
So we always do inside the city. We don't do in the suburbs.
Okay.
Yeah,
Okay.
that is not a good strategy to go in the suburbs.
Yes. And how has your um experience been with rentals?
Oh, it's yeah. So because it's brand new, re tenants want to live like a, they want to invite their friends. It's 9 foot ceilings, it's big windows, it's this living room's brand new. So, you get really high quality tenants,
Mm.
and then we pre-lease them. So
Oh, wow.
even when we're still in framing stage, we're already marketing it, right?
Oh, that's
And it
perfect.
gets fully leased up right away.
Okay, perfect. Nice one. Thank you so much. If we have any other questions, I would answer. John, yes, sir. Do you have your
Yeah,
hands up?
yes, I do.
Yes, sir.
So the question is, uh, where will all this costs for marketing come from? That's question number one. Then number two, what kind of insurance will for the project would we put in place so that in the event, yeah, I mean, it's the builders, I'm sure they have the insurance and all that stuff. But from our own side as well, what kind of risk will the investors be facing, and how do we mitigate those risks?
Mm.
The reason why I say so is because, Kelechi, if you recall, we tried to do something very similar, but at the time we're doing it, the market was tanking. So that was why we suspended that project.
Mm-hmm.
Yeah. So please, those are my two questions. All right. Thanks.
No. All right. Ryan, when it comes to, thank you, John, by the way, for that question. That helps. Thank you so much. So, Ryan, when it comes to insurances for investors, what are they looking at? Because I guess owning the land, building it out, what's the worst case that could happen? I guess that's what, John is trying to ask.
Yes. Yes.
Mm.
Yeah. So, I mean, you have ownership on the land, right? So you guys will structure a corp. That corp will own the land based on, you know, the percentage of the ownership that you guys have. Um, and so, I mean, like your costs are fixed. So we do a fixed price contract. So you don't have to worry about, if Donald Trump does something and then material prices go up. You don't have to worry about, you know, cost of construction going up. In terms of if your building catches on fire, whatever, of course, we have insurance. It's called COC, Course of Construction Insurance. In terms of warranty, we offer 10-year warranty. So, brand new building, of course, not much to fix. But on top of that, there's 10-year warranty. So in terms of owning the land, legally, you own it, you have shares in it. Cost, it's fixed, frozen, doesn't go up. And then anything happens, if the roof falls down, you got 10-year warranty.
I have another question.
Yes.
So if we have this as a JV, I'm sure the corporation will be set up as a condominium kind of thing for management and so on and so forth. Is that how it's going to be? Or what?
No, so for the JV is just to basically own that property as a whole.
Yeah,
And
but with the city for the
oh, with the
approvals.
city. Okay.
Yes, it's not going to be freehold. Most cities will not let you because it's residential property, there's multi units in that kind of area because it's a rental property.
Ryan,
So
how do you go about registering what is it registered as most times?
So it's not a condo, it's registered in one title.
Okay.
Is that your question?
um,
What was your question?
not really,
What was your
because in terms of management of the building. So if we have just one title, okay, yeah, what you're saying makes sense because you don't have different owners. You have just
It's
it's
one
the
title.
corporation that owns, right?
We're not
Okay,
we're not building condos. So you're talking about condos where you strata it. Condos are different. They become multiple owners. That's not what we're doing.
okay.
We're building
This is this single owner type thing, right?
Yeah.
one title. You guys are the owner. This is better. This is my favorite. The reason why is because number one, multifamily, the value is based off the NOI, net operating income. Meaning,
Okay.
if your rents go up by $50, just $50, okay,
Mhm.
times let's say 8 units. So that's
Four
whatever.
hundred dollars.
Sure. Times 12 annually. What is that?
Four
That's
thousand
five
eight
thousand.
hundred.
Right.
Yeah,
It,
4,000. No, that's $5,000.
right. Yeah, whatever that is. It doesn't sound like much. Like what is the, who cares about that, right? But
Hmm.
the magic is where you divide it by the cap rate. So the ongoing cap rate in Edmonton is 5. So if you divide it by 0.05 cap rate, you increase the value by I think it's like 100,000. If you do
Oh,
that.
of the property, right?
Exactly. So just because your rents went up by $50, the value now of your building is now worth 100,000 because it's
Okay.
multifamily. So multifamily is valued like a business. So let's say you have a barbershop business. They don't buy your barbershop based on it looks nice or the location. It's based off the cash.
Cash flow. Yes.
Yes, the EBITDA, and they put a multiplier on that EBITDA. In multifamily, exact same thing. Instead of EBITDA, it's based off NOI divided by the cap rate. So that's why you want to keep it as a multifamily and not as a condo.
Okay.
Yeah, because
Makes sense.
condo, you're handcuffed to the market comparables. So if you sell your house, right, your realtor will say, okay, your neighbor is sold it for 500,000, therefore yours is similar 500,000. This one is not. That's not how it works. It's they don't look at another multifamily across the street, 8 units, and say, oh, it's based off your NOI.
Okay. I have one more. I mean, the last question, please. Last question, because it just occurred. It
You
just
can ask as many as you like.
no, no, because it just occurred to me now. What was I going to say? The yes, the what do you call it? CMHC. Because I have a friend of mine that's doing something similar in Windsor. His own project is 12 million dollars. Affordable housing. What does this have any relationship with affordable housing? Because affordable housing will require that you give about 30% below market rate. Does that impact this project in terms of rental?
Yeah, I can answer this if you want, Kelechi.
Okay.
Yeah, sure.
Okay.
Please, Ryan, go ahead.
So the reason why Edmonton's the best is because it doesn't impact it. Meaning, it's based off the economic gross income (EGI) here in Edmonton. So if you look that up, I know what it is. It's 1,665. Okay, so meaning 25% of your building has to be below that for 10 years. Okay, now in Edmonton, All you do is you select two basements. So if you do 8 units, multiplied by 25%, that's two. That's 2 units. So you need to select 2 units, any units. So of course you select the basements. Basements, you can't even get anywhere near 1,600. So it's automatically good to go.
Okay, perfect.
Whereas in Ontario or BC, then you're getting a haircut, right? And
Yeah.
not the good time.
Yeah. So that's good. Perfect. John, sir, are you good? I muted you because I noticed a background noise there. You can unmute yourself. All right.
Oh
He
no,
says,
I'm good. I'm good. Thanks.
all right.
Thank you.
Perfect. Perfect. Okay. This was good. We still stayed within the time frame. I'm happy that, we had some people show up and I have a recording of this. It's very important that we basically, had the recording because of people who weren't here. They will get the recording automatically, I believe. But at least we can always send it out in the future for those who might be interested. Thank you very much, Ryan, for taking your time tonight to join us today and
Yes, thank
explain,
you, thank you.
the step and step of these structure and all this stuff, right? I appreciate it. As I said, I'm hoping to see you in a few months, I guess,
For
couple
sure,
months.
of course.
Yes. Yeah. Thank you so much, guys, for joining us. We really appreciate you. And it was a good time. And if you have questions, I can arrange a call with you personally and then explain even better, for example, the JV and how it works, the structure and everything. All
For sure.
right. Yeah.
Thank you, guys.
Thank
Thank you.
you. Thank you, Ryan. Thank you very much.
Have a good
Chuka, Chris, John, hi,
night.
Janus. I appreciate all of you. Thank you.
Thank you. Bye.
All right, guys. Bye-bye.
Right.
Yeah.